What is EBITDA? Let's dive into a key financial term every investor should know: EBITDA. Don't worry if it sounds complicated. I'll break it down step by step so you can start using it to analyze stocks like a pro. What does EBITDA mean? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Simply put, it measures how much money a company makes from its operations before accounting for expenses like loans, taxes, or asset depreciation. It's like looking at a business's pure profitability without getting bogged down by non-operational costs or accounting technicalities. Why is EBITDA important? So, why does EBITDA matter? It helps investors compare companies within the same industry, no matter their financing or accounting methods. It highlights operational performance by focusing on cash-generating activities. It's a great starting point for understanding whether a business is truly profitable. For traders, EBITDA offers a clear view of how well a company's core business is performing, making it a valuable tool for stock analysis. How can you use EBITDA? Now, how do you actually use EBITDA? Here are a few tips. Compare it across companies. See how a company stacks up against competitors in the same industry. Track trends over time. Consistent EBITDA growth signals a strong business. Use the EV/EBITDA ratio. This valuation metric helps determine if a stock is undervalued or overvalued. But remember, EBITDA isn't perfect. It doesn't account for debt payments or actual cash flow, so use it alongside other metrics like free cash flow for a full picture. Let's look at an example. Imagine Company A and Company B both operate in the same industry. Company A has an EBITDA of $20 million. Company B has an EBITDA of $30 million. At first glance, Company B seems more profitable. But what if we compare their EV/EBITDA ratios? Company A's EV/EBITDA is 5, meaning investors are paying $5 for every dollar of EBITDA. Company B's EV/EBITDA is 10, meaning investors are paying $10 for every dollar of EBITDA. In this case, Company A might be a better investment because it offers more value for its earnings. Always pair EBITDA with valuation metrics to make smarter decisions. Common pitfalls of EBITDA. While EBITDA is a helpful tool, there are a few things to watch out for. It excludes critical costs like interest and taxes, which can impact profitability. Companies with high debt may appear more profitable than they really are because EBITDA ignores financing expenses. It doesn't account for changes in working capital, which can affect cash flow. Always use EBITDA as part of a broader analysis and not as a sole indicator of a company's financial health. EBITDA is a powerful metric for understanding a company's operational profitability. Whether you're a beginner or a seasoned trader, it's a must-know tool for smarter investment decisions. Now that you know what EBITDA is, how to use it, and have seen an example in action, start incorporating it into your stock analysis today. Got any questions about EBITDA? Drop them in the comments. If this video helped, don't forget to like, subscribe, and hit the bell icon for more simplified stock market tips.